And Eyewitness News keeping an eye on the economy this afternoon. The Federal Reserve extended its year-long fight against inflation by raising its key interest rate a quarter point today, despite high-profile cases of bank turmoil in recent weeks. I spoke with a Duke economist today who called this latest hike a mistake. The Federal Reserve's quarter-point rate hike is the ninth straight in a year. The increases sparked a sell-off in bank stock, causing the banking crisis with the failure of Silicon Valley and Signature Bank. And Duke economist Dr. Campbell Harvey calls this latest move a mistake.
I believe the last time was a mistake also. So I was on record of saying that the Fed should pause. And they should have paused today also for a very simple reason. And I want to know how many banks are at risk right now.
While Fed Chair Jerome Powell said in a written statement the U.S. banking system is sound and resilient, and he also signaled the central bank probably won't raise rates in future meetings so it doesn't disrupt a banking sector already on edge. Harvey feels it's all a red flag.
If they actually have to say it in a statement, it means there's a serious problem.
And Harvey says the problem will now be for consumers trying to get loans, with banks taking a closer look at your credit score and requiring bigger down payments.
The Fed has tightened the screw a little more, and that's going to induce not just higher rates on your loan, but more scrutiny, because anytime there is the hint of a systemic crisis, these banks must become more conservative. So overall, it's a lose-lose for the consumer.
And with this latest hike for the long term, Harvey is pessimistic about the economy.
But as the Fed pushed and pushed and pushed, it weakened the banking system and increases the chance that we go into a deeper recession.
And after this ninth straight rate hike, we will see what happens next. The Federal Reserve's next meeting is in May.